S&P Dow Jones Indices is considering rewriting the rules of the S&P 500. Rules that govern $24 trillion of passive investment. For one company, one IPO, one person. That company is SpaceX. And the valuation they're asking the market to accept, $1.75 trillion. Now, when you hear SpaceX IPO, your first thought is probably incredible company, world-changing tech, I should buy. And look, the engineering is absolutely undeniable. But that's not the real question here. The real question is whether this entire IPO is structured to force millions of passive investors to buy the stock at a price that can't be justified, with absolutely no say in the matter. We're going to break down that structure, the valuation, what's really going on with the XAI merger, and what this S&P rule change actually means for you. All right, so let's start with the rules themselves. Because look, to really get what's at stake here, you've got to understand the system that's being, well, potentially rewritten. So right now, for any company to get into the S&P 500, the rules are pretty straightforward. You've got to have a market cap of at least, $22.7 billion. You need to be a U.S. company. And here's the big one. You have to have been publicly listed for at least 12 months. No exceptions, no fast track. And that waiting period, it's there for a really good reason. It lets the market actually, figure the company out, digest the numbers, understand the business model, let all that initial IPO chaos settle down before all that passive money gets forced into the stock. But what the S&P is considering now is, an accelerated path, a special exception just for SpaceX. And you have to appreciate the scale we're talking about here. This isn't some tiny niche index. It's $24 trillion in assets that track the S&P 500. So when a new company gets added, every single one of those funds, we're talking everything from the biggest institutions on Wall Street right down to your own 401k, is automatically required to buy its shares. They have to. They have no choice. It's not a suggestion. Okay, let's just pause on that for a second, because it's important to understand what this really means for you. Imagine your pension fund manager, the person managing your retirement, calls you up and says, hey, we have to buy this stock. And you ask, is the price fair? And they say, I can't tell you. You ask, do you even think it's a good investment? Doesn't matter. I'm just required to buy it because the index rules say so. That is exactly what forced index inclusion is. It takes away all discretion. It turns your capital, your savings, into mandatory liquidity. So you can see the difference here. Every other company, I don't care how big or game-changing they are, has had to follow the standard path. You IPO, you trade for a full year, you put out your quarterly reports, and then, maybe, if you still meet all the criteria, you get included. But SpaceX, well, they've reportedly made early inclusion into big indices like the NASDAQ 100 a precondition for even listing. They're not just asking to join the club, they're asking the club to rewrite its entire constitution just for them on day one. So it begs the question, right? What exactly is this company that supposedly warrants tearing up the entire rulebook? Which brings us right to the number. The number at the heart of this whole thing, $1.75 trillion. If they get that at IPO, SpaceX would instantly become the sixth largest company in the world. So, how on earth do you justify a number like that? Let's start with this, 94 times. That's the multiple. They're asking you to pay 94 times last year's revenue. Just let that sink in for a moment. 94 times. Okay, so let's put that number in perspective. Remember when Facebook went public? The whole financial world was screaming bubble because it was priced at 11 times forward revenue. Google, probably one of the most successful IPOs ever, listed at around 5 to 6 times revenue. SpaceX is asking for 94. This isn't just high, it's in a different galaxy. In fact, it's a higher multiple than Palantir, which is right now the single most expensive stock in the entire S&P 500 on a price-to-sales basis. So how do you justify it? How do you get people to pay nearly 100 times revenue? Well, you tell a story, a really, really good story, one about such unbelievable growth that today's price looks like a steal tomorrow. And for SpaceX, that entire story is built around Starlink. But stick with me here, because this is where the story starts to come apart from the reality. The story they're selling, the IPO narrative, it all hinges on Starlink hitting 1.2 billion users by 2040. That's the dream. Here's the thing, though. That number, it just doesn't line up with basic economics. Globally, there's maybe 1 billion people who earn enough to afford a monthly satellite internet subscription. But guess what? The vast majority of them already have faster, cheaper, wired broadband. The real market, The people who actually need it and can afford it is probably closer to 32 million households, not 1.2 billion. And we're already seeing the cracks. Sure, subscriber growth is up, but revenue is missing its targets. What does that tell you? It tells you they're already having to cut prices to find new customers, which usually means you're running out of easy markets. Okay, so if the growth story is shaky, maybe the valuation is justified by just massive, incredible profits today, right? Well, the headline number looks fantastic, $8 billion in EBITDA. But as always, you've got to look under the hood. And when you do, you find that number is basically created by just ignoring some very real and very big recurring costs. What's going on here is some classic financial engineering. That $8 billion EBITDA number, it gets there by conveniently leaving out two massive expenses that are absolutely core to the business. First up, satellite depreciation. Starlink satellites don't last forever. They last about 5 years. So you have to constantly replace them. This isn't some one-off expense. It's a permanent cost of doing business. It's like a factory pretending it doesn't have to replace its machines every few years. Then you've got Starship R&D. Billions in development costs are being capitalized. Now, all that means is they're putting it on the balance sheet to worry about later, instead of taking the hit on the income statement today. It's an accounting trick that makes today's profit look way better than the actual cash reality. You factor those two things back in, and that impressive profitability, well, it doesn't look so impressive anymore. But look, the valuation story doesn't just rest on Starlink. It's also propped up by two other huge bets. The merger with xAI and this really futuristic idea of putting data centers into orbit. And this is where things get really interesting, and questions about governance and just basic feasibility start to pop up. So, SpaceX just absorbed xAI at a valuation of $250 billion. But let's look at the actual business. In the first 9 months of 2025, it brought in $120 million in revenue. Okay. But during that same period, it was burning through $1 billion with cash per month. That's like spending your entire annual revenue every 6 days. Its main product, Grok, it's got about a 3.4% market share in a world where ChatGPT and Gemini own over 85%. This doesn't look like a merger from a position of strength. In fact, the whole structure looks suspiciously like Tesla's deal to buy SolarCity back in 2016. You know, using the strong balance sheet of one company to bail out another cash-burning company that happens to be controlled by the exact same person. And then there's the really big long-term dream, putting AI data centers in orbit. And I get it, it sounds amazing, right? Straight out of science fiction. But it runs headfirst into the hard wall of physics and economics. You can't use fans to cool computer chips in the vacuum of space. You have to radiate the heat away. And tests are already showing that even a single powerful chip has to keep shutting down because it overheats. You want to build a 1 gigawatt data center up there? You'd need solar panels and radiators covering 4 square kilometers. We're talking about 40 football fields of equipment floating in space, just waiting to get hit by debris. And the cost? More than 3 times what it would cost to just build it here on Earth. It's a cool idea for sure, but it is a very long way from being an economic reality that can justify today's valuation. So, you add it all up, you've got a valuation that's nearly impossible to defend, a growth story with a huge hole in it, profits that are more of an illusion, and bets that feel like science fiction. Which leads to the big question, who on earth would buy this stock at $1.75 trillion? And the answer to that brings us to what is, frankly, the most brilliant and concerning part of this whole plan, the structure of the IPO, because it's designed to work even if all the logic fails. Here's how the trap works. It's a 3-step play. Step 1, create scarcity. You only list a tiny fraction of the company's shares, maybe 5 or 10%. That's called a low float. And it makes it way easier for a surge in demand to just overwhelm the supply and rocket the price up. Step 2, you force the S&P and the NASDAQ to rewrite their rules for you. Get that immediate, fast-track inclusion and skip the normal 1-year wait. Step 3, that forced inclusion is the trigger. It unleashes that $24 trillion in passive money. All those funds have to start buying your stock. They become the buyer of last resort, and they can't care about the price. This whole mechanism is designed to turn the retirement savings of millions of people into exit liquidity for insiders. And listen, we've seen this movie before. Remember the hype around Tesla's S&P 500 inclusion back in December 2020? It was absolutely massive. Passive funds were forced to buy billions of dollars of stock on that single inclusion day, which of course pushed the price to a peak. But what happened after that? Since that day, the stock has underperformed the S&P 500 by more than 20%. The forced buying at the absolute peak of the hype, It benefited the people selling, not the passive investors who had no choice but to buy. And that brings us right back to where we started. That 12-month waiting period, it exists for a reason. It's there to protect the market, to give investors time to see how a company really performs as a public entity, to get past the IPO hype. Bypassing that for one single massive IPO creates a huge risk for the very passive investors who are the bedrock of our markets. It just makes you wonder, doesn't it? When the rules of the game can be rewritten for just one company, who are the rules really for? Markets reward the people who do the work before the crowd shows up. You just did the work. See you in the next one.